My short is actually very closely associated with my long. That is, interest rates are going up. Central bankers are going to give it a go in the short term. However, I don't believe they're going to have the impact on their domestic currency strength that they expect. Normally, other factors equal, when central bankers begin raising interest rates and at least meeting or perhaps exceeding market expectations, they expect their currencies to rise, at least in relative trade weighted terms. I actually think that's not going to work this time around. They're going to think they're doing, oh, such a great job, but they're not going to achieve the desired results. Why? Well, guess what? They have models. They rely on models. Those models are backward looking, not forward looking. They don't incorporate potential recent qualitative shifts in the way the global investor base perceives the risk reward around their expected policy actions. And normally you'd think, okay, guys, so let's surprise the market. Let's raise interest rates a lot. It'll really strengthen our currency. Might not happen this time around. And the reason why is because of what we've discussed in recent episodes. That is that as a result of de facto, I stress de facto, as a result of de facto capital controls, which are necessary to fully implement a huge sanctions regime that is continuing to be built out
Yeah.
around the conflict in Ukraine on both sides, right? Everyone's doing it. That is not the sort of open, transparent, liquid, level playing field for capital flows that would normally follow from a typical backward looking model comparing interest rate movements and exchange rate movements. And so all the models are not going to work. They're not going to work. They're not going to be worth anything in this sort of environment. And yet, let's be kind about this, but academic types who have studied time series analysis their entire life, who run central banks nowadays, they hate stuff like this. They absolutely hate it. They want to be able to ground a model in a time series. And so that's what they'll do. And when they present it to the board of the Fed, the Bank of England, the ECB, Bank of Japan, whoever it is, and say, hey guys, if you just raise interest rates by 0.75%, maybe 1%, this will be the impact on the currency. This will be the impact on inflation as a result of that stronger currency. They're all going to get it wrong. They're going to get it so wrong, it'll be embarrassingly wrong in retrospect. Now, that said, it's going to take a while to get there. And in the meantime, the trade should work well. You want to bet on them really going for it in the near term, raising interest rates and thinking they're going to look like heroes by doing so. But then don't actually also expect the currencies to rise by much. The currency that will be rising in this environment is the one I've talked about before. It's not a currency at all. It's real money. It's gold. It will be the net beneficiary of all of this. But that becomes a longer term trade, right? That's the position you continue building throughout this process.